A quiet crisis is happening inside the banking system right now. Not on the news, not on social media, not in your group chat. Inside balance sheets, inside loan books, inside interest rate risk. It does not look like 2008. It does not need to. It looks slower, quieter, more technical. And that is exactly why most people will not see it coming. Banks do not fail loudly. They weaken silently. And when confidence breaks, it breaks fast. Today, we examine the warning signs of financial stress in 2026 and how to protect your savings before panic begins. Why this matters: your money in a bank is not sitting in a vault. It is loaned, invested, rehypothecated, exposed to risk. Banks survive on trust, and trust is fragile. History shows one rule: when confidence disappears, systems fail. We are not predicting collapse. We are identifying pressure. Pressure creates cracks. Cracks create crises. Let's look at the signs. Sign number 1. Debt is higher than growth. The first danger signal is simple. Debt is rising faster than productivity. Governments borrow more, corporations borrow more, consumers borrow more. But income growth is slower. This creates tension. Debt needs growth to be safe. Without growth, defaults increase, and defaults weaken banks. Banks hold government bonds, corporate loans, consumer credit, commercial real estate. When borrowers struggle, so do lenders. This is not theory, this is accounting. More debt plus slower growth equals stress. Sign number 2, interest rate damage. The second sign is hidden. Interest rates changed fast. For years, rates were near zero. Banks built portfolios for that world. Then rates rose. Bond prices fell. Loan values shifted. Balance sheets took hits. Some banks absorbed it. Others did not. This is called duration risk. It means long-term assets lose value when rates rise. Banks still hold massive bond positions. Those losses do not always appear on headlines. They sit quietly on statements, unrealized, until they become real. Sign number 3, confidence is thin. The third sign is psychological. Depositors are faster now. Mobile apps move money in seconds. Social media spreads fear in minutes. In past crises, bank runs took weeks. Now they take hours. Trust used to be slow. Now it is digital. When fear spreads, liquidity vanishes. Banks do not collapse because they are evil. They collapse because withdrawals exceed reserves. Confidence is the real currency. And confidence is fragile in 2026. What history teaches: every financial crisis follows a pattern. Leverage builds risk is underestimated. A shock arrives, liquidity disappears, assets reprice violently. It does not repeat exactly, but it always rhymes. The question is not, will stress happen? The question is, are you prepared if it does? What not to do. Let's be clear. This is not about draining your accounts, hiding cash, running from banks. Panic is dangerous. Preparation is intelligent. We do not remove ourselves from systems. We diversify across systems. That is the difference. The solution? Asset diversification outside banking. When financial systems weaken, 3 asset categories historically gain attention: gold, silver, decentralized assets, not because they are magical, because they are not dependent on banks. Let's break them down. Asset number 1, gold, monetary insurance. Gold is not an investment in growth. It is an investment in stability. Gold has no counterparty risk, no default risk, no central control. It does not rely on a bank, a government, a corporation. It is value without permission. In times of currency stress, gold becomes a hedge, a store of confidence, a system outside the system. Gold does not replace savings. It complements them. It protects purchasing power during chaos. Asset number 2, silver, industrial and monetary. silver plays two roles. It is a precious metal, an industrial input. It is used in electronics, solar panels, batteries. It reacts to inflation, supply disruptions, industrial demand. Silver is more volatile than gold, but more responsive to stress. It is not a safe haven. It is a pressure asset. Why physical metals matter? Paper assets depend on institutions. Physical assets exist without them. In extreme scenarios, access matters more than price. This is not about doomsday. It is about redundancy. Systems fail. Backups survive. Asset number 3, decentralized assets. Decentralized assets exist outside traditional banking. They are borderless, permissionless, not controlled by one authority. They operate on networks, not banks. This matters because transfers do not require intermediaries. Storage does not require institutions. Ownership is direct. They are not risk-free. They are volatile. They are young. They are experimental. But they represent an alternative financial rail. And alternatives matter during stress. Why decentralization is a hedge. Centralized systems fail together. Decentralized systems fail separately. This reduces correlation risk, not elimination, reduction. In a fragile world, diversification of structure is protection, not just diversification of asset type. What protection really means? Protection is not perfection. Protection means lower exposure, more flexibility, less dependence. You do not bet on collapse. You plan for disruption. You do not predict outcomes. You manage scenarios. The 3-layer strategy. A protective framework looks like this. Layer 1, traditional banking and investments. Layer 2, physical assets. Layer 3, decentralized systems. Each layer serves a purpose. Each layer reduces fragility. This is not ideology. It is risk engineering. Why most people will not prepare? Because preparation feels boring. Because fear feels distant. Because convenience feels safe. Until it is not. People prepare for hurricanes, earthquakes, fires, but not financial shocks. Yet financial shocks affect food, housing, healthcare security. Money is infrastructure, and infrastructure must be reinforced. What this is not. This is not a call to abandon banks, panic, hoard assets, reject regulation. It is a call to reduce blind trust, increase resilience, spread exposure. Systems deserve respect, not dependence. The emotional trap. When stress rises, people freeze, flee, follow crowds. All 3 are costly. The disciplined response is calm, structured, planned preparation is psychological, not just financial. Real-world example. Imagine this scenario. Markets fall. Banks restrict withdrawals. Governments intervene. Not collapse, control. You still have money, but access changes. In that world, physical assets matter, decentralized access matters, cash flow matters, liquidity becomes power. The core message. We are not predicting a meltdown. We are acknowledging fragility. Fragility is the enemy of wealth. Resilience is the ally. The banking system is complex. Complex systems break under stress. This is physics, not fear. Final warning. The danger is not collapse. The danger is concentration complacency. Blind trust systems fail when users assume permanence. Nothing is permanent. Not currencies, not banks, not policies. Only risk. Final conclusion. A quiet crisis is possible, not guaranteed, but possible. And possibility demands preparation. You protect savings by diversifying assets, understanding systems, reducing dependence, staying informed. Gold, silver, decentralized assets, not as escape, as balance, not as rebellion, as insurance. If this analysis helped you think more clearly, like this video, subscribe for professional financial risk analysis. Comment resilient if you believe preparation beats panic. Because when systems shake, the prepared do not panic, they adapt.